ശരി, വ്യക്തമാണ് അതുല്യ. ഇപ്പോൾ RBI ഗവർണർ മാധ്യമങ്ങളെ കടന്നു തത്സമയ ദൃശ്യങ്ങളിലേക്ക്.
Inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook, real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025, following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust Kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January, February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data, period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust. I will now be talking about the liquidity and the financial market conditions. System liquidity was in deficit in January 2025, with net injection under the liquidity adjustment facility scaling a peak of more than 3 lakh crore rupees, in fact 3.1 lakh crore rupees on 23rd January 2025. However, as a result of a slew of measures, and I'll not go into the details thereof, you're all aware of them, of the various OMOs, the CRR rate cut, the swaps that we have done. The system liquidity deficit tapered, therefore, during last 2 months of February and March, and further it turned into a surplus on 29th March 2025. Further, coupled with the government spending picking up pace during the latter half of last month, March, the system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025, and even yesterday it was 1.4 lakh crore rupees of surplus. Reflecting these developments, the weighted average call rate softened and remained near the repo rate since the last policy meeting. The spreads of 3-month CP and 3-month CD rates over the 91-day Treasury bill rate have also softened since the second half of March, suggesting an improvement in liquidity conditions. I would like to mention over here again, I'm reiterating this, I have said this earlier, which is that the Reserve Bank is committed to provide sufficient system liquidity. We will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures to ensure that there is adequate liquidity in the system. Coming to financial stability, well, I do not have much to add from my previous policy statement in February. Things are more or less looking similar. The financial soundness parameters of the banking sector continue to be robust. The liquidity buffer in the banking system is well above the regulatory threshold. Profitability indicators are also healthy, reflecting robust operational efficiency of the system. Similarly, the system-level parameters of NBFCs too are very sound. Now, as has been the practice, I shall be announcing some additional measures. This time I have 6 additional measures to announce to all of you, and these relate to banking regulation, fintech, and payment systems. First, we propose to enable securitization of stressed assets.
മാധ്യമങ്ങളെ കാണുകയായിരുന്നു. റിപ്പോ നിരക്ക് 0.5% കുറച്ച് RBI. റിപ്പോ നിരക്ക് 0.25 കുറച്ച് 6% ഭവന വാഹന വായ്പ പലിശ നിരക്ക് കുറച്ച് വ്യക്തിഗത വായ്പ കുറയും. പലിശ നിരക്ക് കുറയ്ക്കുന്നത് തുടർച്ചയായ 2ാം തവണയാണ്. സെൻസസ് 400 പോയിന്റ് നഷ്ടത്തിൽ ബാങ്ക് നിക്ഷേപ പലിശയടക്കം കുറയും. ഇത് 2ാം തവണയാണ്. തുടർച്ചയായ 2ാം തവണയാണ് പലിശ നിരക്ക് കുറയ്ക്കുന്നത്. RBI ഗവർണർ മാധ്യമങ്ങളെ കാണുകയാണ്. മറ്റു വാർത്തകളിലേക്ക്. ഇന്ത്യയടക്കം 86 രാജ്യങ്ങൾക്കെതിരെ അമേരിക്ക പ്രഖ്യാപിച്ച